Yes.
Good evening, friends. Speaker of the today session, Rajiv Mehrotra. Viewers of the viewers joined for virtually for the today's program. Pleasant good evening to all of you. Today's topic: penalty under Section 270A and 271 AAD of the Income Tax Act. There is a lot of thoughts in this penalty under Section 270A and 271 AAD of the Income. Why was the Section 270A was enacted? How is the difference from Section 271 1C? In response of which income 270A bills and CAT can leave a penalty under Section 270A? And what are all the proceedings can be launched for 271 AAD? These are all the crux point with respect to penalty under Section 270A and 271 AAD. With respect to this, I think that the today's speaker, Rajiv Mehrotra sir, will be the best person who can deal with the expertise on this. Coming to the present task of introduction of the today's speaker, I deem it a great privilege to introduce today's speaker, Rajiv Mehrotra. He is a chartered accountant, qualified DISA. He is in practice as a chartered accountant since 1994, having a partnership firm under the name and style of Rajiv Mehrotra and Associates. He is BSc Hans from Hansraj College, Delhi University in the year 1980 and was placed first in the college and was in the merit list of the Delhi University. He is also merit student in CA Inter as well as CA Final. He is did ACS Inter in the year 1982, qualified DISA March 2003. The other activities, he is a committee member of the Upper India Chamber of Commerce, ex-vice chairman, secretary and treasurer of CARC of ICAI, have remained the president of the Kanpur Income Tax Bar Association, the past president of Kanpur CA Society, presently honorary chairman of Amir Maritime Training Academy, and has remained independent director in companies. Have varied experience in tax, SIRC cases, FDI investments, and cross-border transactions. He presented several papers in conferences of all levels on direct taxes, accounting, etc., and articles for newsletters and magazines. He is a committee member in NLK group of schools under the aegis of Kanpur Education Society. He is a member of Rotary Club of Kanpur. With this proof profile, I present today's speaker Rajiv Menon sir to the August audience. Sir, Rajiv Menon sir.
Thank you.
The screen is yours. You can proceed to present your.
Thank you. Thank you so much. Thank you. Thank you, Mr. Reddy. Thank you, Mr. Reddy. I am privileged to be a part of this August gathering and be part of the discussions on basically typical issues of 271 AAD. Firstly, I have taken, then 270A I have taken later on, because to my mind 270 AAD is a draconian section. I am grateful to the SIRC for giving me an opportunity of having my discussions with you, and of course I hope the questions will be at the end of this, and of course I'll share the PowerPoint also, so that the members can benefit from the basically PowerPoint which I have prepared. And of course, if the members have got any suggestions and queries, I'll be willful, because this discussion and virtual conferencing is always a means of learning for all of us. In fact, we are also learning. I am also learning. It's a good discussion, and virtually, of course, sitting from Kanpur to Chennai is a very good system, and I am sitting virtually in Kanpur, and everybody is sitting in SIRC, and we are having a conference, so that is also great. So now I would like to share my screen and start the topic per se.
Sir, please. Sir, visible.
The screen is come?
Visible, sir. Please continue.
Okay, the screen is visible?
Yes, visible, sir. Please.
Okay. Okay. So now let's come to the penalty proceedings. First, let us talk about basics of penalty proceedings. See, penalties per se under the Income Tax Act, or for that matter any other act, every addition to the income of the SSE does not warrant any penalty. So every addition does not, I am talking about basics, means all penalties per se. Secondly, there's no penalty for technical or venial breach. I mean, a lot of, of course, Supreme Court is here, and there are a lot of judgments on penalties in relation to TDS or other similar provisions where they say there's a technical or venial breach, penalty should not be leviable, because basically a technical breach, prima facie, except for some sections that talk about a mala fide and approach where penalty should be leviable. Mere affirmation of an addition by the appellate authorities does not automatically make the SSE liable for penalty. Fresh evidence can be resorted in the case of penalty proceedings. And of course, no appeal quantum. If I do not do any appeal against the quantum proceedings, it does not automatically imply that penalty should be leviable. And of course, now the statute is on 270AA has said that you don't go into an appeal, you just pay the taxes, and there's no question of penalty. So that has been recognized by the statute by 270AA that not necessary to levy a penalty even if I don't go for appeal against the quantum. Again, another important point is that law at the time of filing original return to prevail as regards penalty, because a lot of amendments regarding penalties. But suppose now 148 cases have been reopened and they are being done in the current year. Suppose 2013-14 case. So if it is done in the current year, the penalty will be leviable if at all for the year had the law prevailed in the year 2013-14 or 14-15, 15-16, whatever. It will not be leviable as per now because there are certain sections which have come later on. But penalty is applicable for the filing of the original return. So that is basically the penalty to be levied. Right to be heard is a statutory right in the penalty, and reasonable cause under section 273B. With most of the penalty sections, except few which I have discussed, you can escape the penalty by giving a reasonable cause, and it has to be to satisfaction of the assessing officer. Now, another important is penalty not to be imposed if the assessee proves that the failure to comply with a reasonable cause. This section applies to all penalty sections except 271AA-B, 271AA-C, 271AA-D, which we are discussing today. 271AA-E also I have taken part of that, 270A and 271. So all these sections, there is no rescue under section 273B that, okay, I had a reasonable cause and the penalty could be dropped. So therefore, there is no rescue under 273B regarding these sections, which means that basically these are sections wherein you have to prove that you were right and penalty should not be leviable. Now, what is a reasonable cause? This is also important because not here, even in 270A, they have talked about reasonable cause. Reasonable cause per se is a person with the Supreme Court in Azadi Bachao Andolan. It's a very good case. It was against the Mauritius Tax Treaty, where Supreme Court had recognized the Indian-Mauritius Tax Treaty and said it is basically, see, McDowell case was there which used to talk about evasion of tax. Azadi Bachao Andolan, they had a case against Union of India. It's an NGO which filed, and here it was regarding Indian Mauritius Tax Treaty, which said that it is giving undue advantage and it's against the country's basic objective. The Supreme Court said no, tax planning per se is permissible. It's not basically avoidance of tax. So therefore they said it's permissible, and there they said categorically the expression reasonable is not susceptible clear and precise definition. For an editor to give a meaning, the word reasonable is trying to count not the number and measure of what is not in space. It can be a rational according to dictates, which means a reasonable cause will depend on case to case and the rationale of people. And two other cases, they've been taken very categorically. In Woodward Governors, again, its text talks about would reasonably lead any ordinary, prudent, and cautious person placed in the position of person concerned to come to the conclusion that same was the right thing to do. So it's a normal, ordinary person. If he comes to a conclusion that it's the right thing to do, it is a reasonable cause, and for that, penalty would not be leviable under 273B if you take the rescue. And in fact, 270A also, they have talked about bona fide. Let's talk about bona fide. It's a very good case against Supreme Court in PwC Cooper versus Supreme Court. So what did they say in Supreme Court? You know what PwC did was it did not add provision for gratuity, which under 40A7 should have been added to the computation of the income to make it taxable. So they did not add it. And on the tax audit report, of course, it had shown 240A7. So it went to the Supreme Court, and Supreme Court has, you know, what did they say? Notwithstanding the fact that SSC is undoubtedly a reputed firm and has great expertise available with it, it is possible that even SSC could make a silly mistake. So that's what Supreme Court has said, that there's a silly mistake, inadvertent error, failed to add the provision of the gratuity to the total income. It's a human error, and the caliber and expertise of an SSC has nothing or little to do. Of course, see, a lot of people can escape out of this because if a PwC per se, the Supreme Court can say that it has done an inadvertent or human error, then and another very important fact is that if you've gone to 140A cases, 148 cases in Supreme Court, Ashish Agarwal versus Union of India. So there again, Union of India versus Ashish Agarwal. See, I fail to understand, of course, not commenting on the caliber of the judges of the Supreme Court, but stating there that it was a bona fide mistake of, say, thousands of officers who did not apply the law rightfully, and the Supreme Court had to take this 142 article 142 and to its rescue, and then change because of it saying that basically affecting 90,000 appeals. They reversed the judgment of so many high courts, in fact reversed or modified the judgment of so many high courts, and saying that it was a bona fide mistake of the officers. One we don't understand that how can there be a mistake of more than, say, 1,000 officers or 5,000 officers for interpreting law in a wrongful fashion, and then of course Supreme Court giving its consent to that. So now the question is that if that can be the rule as far as Supreme Court is concerned in favor of the officers, then similar rules could be applied in favor of the SSCs if such situation arises. I don't know how far the courts are going to agree to it, but one could take a rescue from that Union of India versus Ashish Agarwal and say that that benefit could be given because a bona fide mistake is there. And of course, PricewaterhouseCoopers is again a very glaring judgment, which they say that even PwC can make inadvertent errors. Now let's come to section 271AD. Friends, it's one a very draconian section, and draconian when I say that because it is now applicable with 1/4/2020, and what a lot of people are not applying. We are doing search cases, and search cases, a lot of problems are coming. And I would like to discuss this section threadbare because it is a section which can affect you and me as well. As a professional, a liability can be put on you. As a professional, a liability can be put on me for a conduct of the SSCs, and a lot of CAs, of course, are now being put into a problem with saying they're part of GST racket or this racket, and even the clients are giving false notions that my CA was involved. So all those things will lead to a very huge amount of penalty under 271AD to any or all of us. So now let us start with what does it say. It says without prejudice to any other provision of this act. So if during any proceeding under this act, I've highlighted all the portions which I'm going to discuss, it is found that in the books of accounts maintained by any person, there is a false entry or an omission of an entry to evade tax liability. False is not linked to evade tax liability, but omission is essentially linked to evade tax liability. Then the assessing officer or the CIT appeal. Earlier CIT appeal was not there, but Finance Act 2022 has added the word CIT appeal now. So For earlier years, means 1/4/2020 onwards, CIT appeal will not be permitted. But of course, 1/4/21/22 onwards, even CIT appeal can levy a penalty under 271(a)(d), and it may direct that such person shall pay by way of penalty a sum equal to aggregate amount of such false or omitted entry. See the draconian section. It is the entire amount of false entry or omitted entry is liable to be penalized under 271(a)(d). Now, here where we are affected, without prejudice to the provisions of subsections 1, the assessing officer or the CIT appeals may direct that any person who causes the other person referred to in 1 in any manner to make a false entry or omits or causes to omit any entry referred to in that subsection shall pay by way of penalty a sum equal to the aggregate amount, which means any person who causes the person referred to in any manner. So there, the third party, an entry provider, a professional, or for that matter, if you talk about an on money, which we have taken in the case studies, even this broker who's a property broker, he is caught supposed to regarding on money which is not entered in the books of account. So the entire on money will be liable to penalty, and the broker, because he was a party to that, to make that false entry, again he'll also be liable to such amount. It will not be amount to his brokerage for the entire entry which is omitted to evade tax. So that is the draconian provision of this section. See what was the objective and where it has resulted. The notes on clauses talks about it. If it is found in books contain a false entry, it was talking about GST basically, because GST, there's a similar penalty. They said that a lot of people are issuing false invoices under the GST Act, and therefore they are evading income tax as well as having benefit of GST. So such person shall be liable to pay of penalty equal to aggregate amount of such false and omitted entry. So that was the objective, and this objective has resulted in where we'll see in future slides. See, penalty for fake invoices. Again, this was explanatory memorandum. Fake invoices are obtained by registered. This was the part of the memorandum. Fake invoices are obtained and registered under GST to fraudulently claim ITC and reduce the liability. These invoices are found to be issued by racketeers who actually carry on business or any business profession. So objective was to catch hold of the racketeers as far as the GST is concerned, and such fraudulent revenue deserve to be dealt harsher. Fair enough. I think that's a good cause. If you're getting a racketeer, if they are doing fraudulent arrangements, they should be penalized. But objective is that, but when enacted, I was just discussing, I don't know, it's so humorous that we just go to the last 4 years, and if you just go to the last 4 years, the Income Tax Act, which has got 298 sections, they have got amendments of more than 400 amendments, 354 amendments, and I don't understand why every year the act has to be amended. 100 clauses are amended of an act which has 298 sections. I don't know. It was on the lighter side. It was a clerk was appointed in the finance ministry, and he was putting his table at proper place. He was just shifting his table. Then once at any point of time, he reached before the toilet and placed his table there. So and he then for quite some time he sat there, he placed a table there itself. So somebody asked, why have you placed this table in front of the toilet? He said that in the finance ministry, of course, not finance ministry, basically it is basically where the tax TLP, of course, where the legislation is drawn. He said this is the only place which they know what they have to do and what they are doing, because otherwise every year they are enacting, changing the law without any logic, or if logic, which means if 1% or even 0.1% someone has done a wrong, they change the law to affect 100% of the cases. So which is basically why we talk about the Income Tax Act being so complex, and why there are not many people who are able to have a composite reading of the Income Tax Act, because in any other nation, if you talk about any other nation, US or Japan, you won't find amendments from years to years regarding the act. Whereas Income Tax Act, of course, amendments are regularly there, irrespective of conditions and cases. So that's what I'm saying. The penalty was for objective was very different, and enactment has been totally different. Issues arising. What shall be the date of applicability? Because it says that insertion of section on 1/4/2020, implying thereof whether proceedings completed on or after 1/4/2020, assessment year commencing on or after 1/4/2020, or financial year commencing on 1. Because normally in the act, when they say that section shall be effective from 1/4/2020, it's basically assessment year 2021. So 2021 means all income tax proceedings completed on or after that. That will not be there, as I discussed. That penalty is basically for the assessment year on which the return, for which the return is applicable. So of course, irrespective whenever the proceeding complete, these sections are not applicable. Assessment year commencing on or after 1/4/2020, again, it should not be there. I have given case laws, but it will not be there. And basically, it will be applicable from basic invoices or fake invoices found or the act enact after 1/4/2020, which means any such thing which is found after 1/4/2020, this section shall be applicable. And why I say so, because see, it's the very good judgment. In fact, constitutional judgment. There are a lot of judgments which have come in the light of when they interpret the constitution. And constitutional bench in Vatika Township has very beautifully held is that legislations which modified accrued rights or imposed disabilities have to be treated as prospective in nature unless they were accounted for obvious omission or explaining of former legislation. So if there's obvious omission, then of course they can be prospective to impose disability. Retrospective meaning to a provision should only be made to correct a law to the benefit of the taxpayer, the judges added. What does it mean? That retrospective amendments, if any, can be done only to the benefit of the taxpayer. They cannot be added to the against the taxpayer to pose any problem to the taxpayer. It unequally also provides that legislation which imposes new obligations should be treated as prospective, but the same which comes to the benefit should be construed as retrospective. Implying thereof, the Supreme Court has said that anything which imposes new obligations should be treated as prospective. Of course, there are a lot of issues now coming under the Black Money Act, because the Black Money Act again has been enacted in 1516, and it has now taken back provisions of the last 15 years of the opening cases. I think let's of course, there's a tribunal judgment of Bombay which says that it can be it will have retrospective applicability, but considering this Article 20 of the Constitution, if you really see that what this Article 20 says, as per Article 20 of the Constitution, there can be no retrospectivity as regards penalty provisions, though it is held in some cases that Article 20 shall be applicable to criminal proceedings. Article 20 categorically says that as such there can be no retrospective as regards penalty. Article 20 is very clear, which says that you cannot be put to worse position where you were when the crime was committed. For example, 5 years from today, there was a 10-year imprisonment on a crime of murder. Suppose 5 years today. So today I cannot amend the law retrospectively saying that, okay, from 2010 or 2015, the crime of murder is increased to 20 years. No, I cannot. Because the law at the time of committing the crime cannot be amended retrospectively to against the person who is convicted. So that is very clear as far as Article 20 is concerned, and therefore Vatika Township has said that anything to the benefit of the person concerned can be done retrospectively, but against can be done prospectively. Now there are a lot of amendments as far as Companies Act is concerned, where they are talking about of criminality has been removed. So there again, that it can be a benefit, taking the benefit of retrospectivity, saying that these are beneficial provisions and retrospectivity can be taken. Now the section started without prejudice to any other provision, which implying thereof, we'll see in the case studies that 271AA will be applicable, plus 270A may be also applicable. And there, of course, if it is a misreporting, then there'll be 200% of the tax penalty is concerned, it will be in 270A, and there could be 100% of the transaction value of penalty under section 271AA. So just, and the section, the actual wording of the section are very similar. When you talk about 270A under misreporting, you'll find very similar language. So therefore, two penalties equivalent, of course, tax will be levied, that is there, but penalties against, if they are 200% of the tax, which means if the tax is 30%, it will be 60% there, and 100% of the transaction values is here. So 160% of the transaction value would be the penalty, and in addition, there will be a tax 30%. So effectively, you just understand what the person has to pay. If the transaction value is 100, the penalty may again go to 200, which is just phenomenal. Double jeopardy. Can the person be penalized from same wrong at two places? It is a penalty of double jeopardy. Although again, Article 20, as I already had mentioned earlier, is that no person shall be convicted for any offence except for violation of law enforced at the time of commission or act charged as an offence, nor be subjected to a penalty greater than which might have been inflicted under the force at the time of commission of the offence. I had already discussed that. And no person shall be prosecuted and punished for the same offence more than once. Of course, that is there, but as far as here double jeopardy is concerned, that may not be applicable in this case. The phrase, again, proceedings under the Act. The phrase is very wide and can mean proceedings under assessment, under survey, under search, under appeal, under revision, under rectification, passing an order to give effect to an appellate order, etc. would cover even proceedings under section 133(6), proceeding by INCIs, as all wings have AOs assigned jurisdictions. So it does not say proceedings under means only under assessment proceedings. It talks proceedings under the Act. So therefore, if a survey has taken place and the AO has found during course of survey that certain, of course, false entries we'll discuss later on, but certain entries or fake invoices have been found during the course of survey which the party had entered. So even at the time of survey, irrespective of the assessment, the proceedings under 271AA can be started. Of course, the question will arise that whether the survey AO, of course, because now, although from current year onwards, the principal CC has also been given a charge to, of course, commence surveys, or JAOs or jurisdictional assessing officers can also do surveys. But from this year 22 onwards, 1422 onwards, but earlier, of course, the last 2 years only DIV could do. So whether DDI can levy a penalty or not, that of course we'll discuss. But per se, survey initiation of penalty, as normally we understand that penalty has to be initiated with the assessment order, which means in the assessment order. So here, of course, it's not necessary that the assessment should be done or assessment order should be passed or assessment is taking place. It can be done in the survey also, because it covers the other person as well. So that of course, for example, if a survey is done under A and there's a fake invoice issued by B, so A, of course, will be levied for this penalty. Even the person who has issued a fake invoice will be levied penalty, as we have discussed earlier. The phrase does not include proceeding under any other act. So therefore, suppose there is a penalty found under GST Act, and unless until that is conveyed to our assessing officer, means in the Income Tax Act, only then it can be initiated. Otherwise, the penalty cannot be included proceeding under any other act. Thus, for information from some other source, the AO would have to start some proceedings under the Income Tax Act. So unless until any proceedings are started under the Income Tax Act, no penalty under 271AA can be levied. Power to levy penalty. 271AA earlier authorized only the assessing officer and no other authority. As against the same, section 270 allows 270A allows CIT appeal as well to levy penalty. From AY 2022-23, CIT appeals can also levy penalty. Thus, evident the penalty can be levied only in respect of proceedings which the assessing officer now also before the CIT appeals. So now, please also ensure that CIT appeals who earlier could not can levy penalty. But of course, CIT appeals has got a limited. Of course, they say that they've got a concurrent jurisdiction. But for enhancement cases, because if CIT appeals initiates penalty, it has to be basically a case of enhancement, and then the process of enhancement has to be gone through, and then of course he can initiate penalty. And as regarding assessing officer also, as per section 124(1), they have to be assigned jurisdiction, and when the penalty has to be levied, so such other person. We have discussed penalty to the person who's convicted plus such other person. So of course we have to pass on the case to that jurisdictional officer to levy a penalty. Order being appealable, the jurisdiction of the CIT appeals is decided on the basis of the AO. As we all know that the CIT appeal jurisdiction lies on the AO. Of course, now basically it's a faceless assistant officer search and survey. You never know where will the penalty proceedings go. Books of accounts, because we have already seen in the original section that we have discussed prejudice, proceedings, and now books of account maintained by any person. So books of accounts, as far as the Act is concerned, is books of account includes ledgers, day books, cash books, other books which kept in the written or printouts or data stored in a floppy disk, tape, or any other electromagnetic. Now, whether a person who's not required to maintain books of accounts in the provision of the Income Tax Act or under the present taxation, but is maintaining books of account to any other law, would he be covered? E.g., a person, for example, so suppose I don't have to maintain books of accounts. So there has to be a false entry or omission in an entry if I am maintaining a books of accounts. If I don't have to maintain books of accounts, this section will not be applicable. Now, if I'm maintaining for any other purposes, then to my mind, 40 this or and even I am filing 4480 return under the provisions of Income Tax Act, then to my mind the penalty could be leviable, because it does not say books of account under the Income Tax Act. It talks about maintaining books of accounts and fake invoices in the books of accounts. So if a person is having fake invoices in the books of accounts, though not maintainable under the Income Tax Act, but maintained under the Act, the penalty could be, of course, it's a gray area, it's a legal battle, but the department is always going to take that plea that the penalty could be leviable. Now, what is liable for penalty? That is very important. A false entry or an omission of an entry which is relevant to the computation of total income such person to evade tax liability. So omission has to be read with evading of tax liability. One has to ensure that there is omission and evasion of tax liability. Allahabad High Court, for Singh traders, has said false means what is more than incorrect or erroneous. It implies wrongful or culpable negligence and knowingly or negligently untrue, which means a mala fide, a mens rea. False, it has to be intentionally incorrect. A bona fide mistake will never take the word false. So if I entered, for example, now what happens is a lot of GST rackets are caught. Now, suppose I have taken an invoice with a bona fide belief that the earlier person has paid. Of course, he might have taken a proper invoice. He had paid GST. He gave me a GST invoice. I have paid. I have taken input credit, and I have entered that entry. But the third link, the original invoice which my supplier had taken was a fraud. It was a fake invoice. There, of course, because I was not aware and was not under wrong or culpable negligence. So therefore, to that extent, I will not be liable to the penalty, because my intention was never false or fraudulent. And now false, see why I say this, where they've gone too far is that false, they've said and explained in the Act itself. False for the purpose includes or use or intention to use false or falsified documents, such as a false invoice or false piece of documentary evidence. Say a false rent agreement. A lot of people, with all the apologies, a lot of people pay rent to get the benefit in salaries. Now, if they pay rent in getting salaries, and of course, the question will be books of accounts, they may not have to maintain, so they may be rescued of that. But of course, if it's a false entry and the other person is giving false entries, then you never know that, because to such person, the other person is not required to maintain books of accounts. The main person who's accused has to maintain books of accounts, and if the entry is found false in their book of account. But such other person, as we had discussed in subclause T2, for him, maintenance of books of account is not essential. So if he is given a false invoice or false evidence or false document, and he is not maintaining, he is not required to maintain books of accounts, penalty can be leviable on him also. Invoice in respect of supply of receipt of goods or supply or services, or both issued by a person or any other person with where actual supply of received such goods or services is not there. So that is again another issue. Invoice in respect of supply or goods received of such person to and from a person who does not exist. This is another very problematic area because we are finding a lot of cases under 148. What is happening is that that you'll find uh, at times you have purchased material from someone and the person you purchased through or you paid by account pay. I'll give you a case of my own. I think of 20 years back. I was a sandalwood exporter. I purchased sandalwood from parties in Delhi. The sandalwood came in Kanpur. It was through the sales tax forms. It was vetted by the sales tax authority on the borders, and it was exported out of India with customs regulation. Now, when the department wanted to check on the parties, they gave 131 or 131 or 136. None of the parties were found existing at that place on the date of the assessment. Now, I had contested when I said that okay, when I bought the goods, the sales tax department, the custom, everybody has given their consent and they have recognized the purchase made by me. How do I ensure that till the date of where I am assessed, that person should keep on existing? Because it is, I cannot ask the person to keep existing till my assessment is complete. So now here, for example, if you go to the Bombay or the DI wing, there are a lot of rackets which are being found and on the websites. They say that diamond exports. A lot of companies were issuing fake invoices, but actually they were exported. So what happens is that if I am buying diamonds from a company in Bombay, he's given me actual physical diamonds, and he's given me an invoice, and he's taken payment through account pay check. Tomorrow I do not know because that whether that company from which he has given me an invoice was only an invoice giving company because he gave me a physical delivery. I don't know whether it was an invoice giving company or it is an actual company. So to that extent, I was correct. So now they say that person does not exist or an actual supply was not made. So if a person does not exist, or he was not existing at that time, or as they call it, it's a shell company, or all those things. So those problems can arise in these cases also because the intention it includes intention in or use or intention to use. So therefore, these problems may arise from the act of the department. Although if we prove the bona fide, then of course we can escape that. But these problems will arise, and at least in search and survey cases, there are a lot of problems will arise. And emotion of an entry to which is relevant to computation of person to evade tax liability. Here, as of course discussing in the case studies, we don't know whether we'll get time for that, but I'll give an example. There's a search or a survey or anywhere of a builder, and certain entries of on money are found. That on money was taken by the builder, and that on money was not recorded in the books of accounts. So clearly, it is an omission of an entry relevant to the computation to evade tax liability. So therefore, it categorically falls under this clause, and a penalty to the extent of that such omission could be taken place. Now, let us come to this. Now, if imagine this position, this penalty will be leviable, and if it is a cash receipt, a penalty to the contravention of 269 ST may be leviable, which says that more than 2 lakhs has been taken in respect of any transaction or any particular event. So 279 ST may be leviable, and 270 double A may also be leviable, stating that 270A, sorry, will be leviable of it's saying it's a misreporting of income. So you never know on a single transaction how many penalties could be leviable and where you can get caught. So on money transactions, if they are now really caught during the course of search and survey, though the department is not very, I think fortunately not much aware of all these things, but these penalties are very draconian and can really, and again, another problem, as I said, is that suppose in one of my cases, a few years back, there was a broker note and a broker's actually a loose paper was found as a incriminating material, that the broker, through the broker, booking were made, and that bookings were made, and certain on money was taken in, as well as check was taken. So if a broker is also liable, is also part of that, then again he'll also be liable, and the person who's paying cash may also be liable, because such other person, as they say, as we had discussed, could be liable. We'll discuss again in next slide. Both false entry and omission to evade tax mens rea is to be found as 271C, and the important point as far as this is concerned in this section is the burden of proof is on the AO, and a finding of the same is essential in his order, saying that it was a false or a omission to evade tax. Because it's a mens rea, therefore the burden of proof lies on the AO. Restrictive expandable explanation of false. Now, because false, as I said, is includes or intention to use or intention to use, so it's an inclusive definition. So whether it is an expandable definition or it is restrictive definition to these three examples only. It's a debatable. We have to study three doctrines and then we'll answer it, compromise, restrictive, inclusive. Of course, the Kanailas versus Parmanadi Sadhukar, again Supreme Court, it was held that plain meaning rule suggests that when the language of statute is plain and ambiguous, the court has to understand the plain language, and as such, there is no separate for any scope for any interpretation. So here, of course, they say it should be inclusive and it should be taken into account. Ejusdem generis, that is important. What does principle of ejusdem generis say? It says that the words of a general nature following specific word should be construed as limited to things with while the same nature as those specified. Example that if it is stated sun, moon, or other large objects, then it has to be only celestial objects. Or it says artisans, workers, laborers, or such other person, then it has to be only artisans, workers, laborers, and such other person which are related to laborers, workers, artisans, similar to that. So therefore, false, when we talk about, it has to be restricted to those entries. Principle where include would be interpreted as mean. Because there are certain judgments of beautiful, very good judgments of Supreme Court which says that the word includes is written there, but primarily the word includes has to be read as means. It seems to us that the word includes has to be used in the sense of means. This is the only construction that law can bear in this context. So therefore, to my mind, again, AO may take more entries into account other than those three already in the explanation, but to my mind, it should that this include word should imply mean, and of course we can take rescue of these judgments and principles and say that of course that is a restrictive definition. No other things should be taken into account other than those three mentioned there. Now, I was talking about 271(88)(d)(2), penalty on any other person without prejudice. Again, here is non-obstante clause of subsection 1. The AO may direct that any person who causes the person in any manner to make a false entry or omits or causes to omit any entry shall pay by way of penalty a sum to the aggregate amount of such false or omitted entry. Now, see, what will happen is that suppose now I am paying cash for purchasing a house. It's a cash and check deal. 60% is cash and 60% is check and 40% is cash. And the entry is found with the builder, and there's a broker involved. Now let us see. That any person, it does not say there can be one or more, many persons, who causes the person in any manner. If the broker does cause this entry because he makes two persons come to meet, and I am the person who's giving cash to make a false entry. So therefore, all the three persons could be covered in this aspect. I've taken a case study later on, which can be again discussed here itself. I'll not go to the case study then. Now, what happens is that there's a circular transaction at times, which I've seen for the bank purposes. A lot of companies are doing. Suppose A supplies materials to B, and B supplies material to C, and C supplies material to A again. So, and actually there is no flow of materials. There's a billing from A to B, B to C, and C to A, or C to D and D to A, suppose now. And this leads to enhancement of turnover, but actually it is basically bills which are raised from one company to another company, and this is circular transaction happening. A lot of companies we have seen, of course, who have done it for increase in bank limits or increase in turnover, things like that, which are actually not physical turnovers, but they are book turnovers. Now, if A has given to B, B has given to C, and C has given to D. Now, see, all these parties are liable to penalty because they A, B, C on the same amount. Suppose the invoice is only of 100 rupees. So 100 rupees A to B, B to C, and if suppose the auditor of the all the firms is same, then he'll be knowing, he has to be knowing that, or for that matter, suppose the assessee who is caught with such entry says that it is the accountant or the auditor or the person concerned or the consultant or anybody was a person who advised me to do this entry, then the penalty will be leviable to such person as well. So there arises a very big problem, because you know what happens in search, most of search cases, they say, where are books of accounts, or survey cases, sir, they are lying with my chartered accountant. So why was this entry not done? Sir, I do not know. This CA should not have done it. Why the fake invoices? Sir, I am not aware. So all the accounting is done by the chartered accountant concerned, or the advocate concerned, or the my accountant concerned. So if it anyway, because it's who causes the person in any manner to make false entry or omits costs. So therefore, it is a draconian position to such extent that, of course, they have to prove that there was a malified intention of the CA or the person concerned for such an entry. But again, this does not absolve the person or the middle person or the middleman or such other person from levy of penalty. How, of course, how levy penalty of the person who does not have a jurisdiction? That again is depending on the person. The AO may refer the matter to the such person or AO, and then of course from there the penalty could be taken up. Again, if he refers the matter to some such other AO, then that AO will have to start certain proceedings under the Income Tax Act, which may say that he may start 133(6), he may start 148, because the penalty has to be levied only there is a proceedings under the income tax. Without any proceedings, there can be no penalty per se. So the proceedings have to be started on such other person, and then only penalty can be levied. As such, for example, if I am assessing a builder, I have to start a proceeding in the case of the customer and the other person, and then of course the penalty can be levied. Professional, as I said, certain rules paper. So liability of equivalent penalty would be, and the penalty is equivalent. So of course, businessmen, if they take plea of the account, suppose there are omission of certain entries, this as I said, which have a bearing on the income, and they say that of course the accountants are responsible and employees are responsible, then what do we do? Issue may arise, what if assessment of such other person is complete and with no such adverse inference findings to false invoice assessment order of such other person? If the assessment of such other person is complete and no such adverse finding is was false invoicing in that person, it can be to my benefit or it can be to his demerit, again reopening of invoices. Because 148, again, a lot of cases have come which are basically on the inside portal, they are flagging on the, because now Act 148 is talk about flagging off or the CAG objections. So there are certain objections of flagging off, saying that okay, it was a racket found in Calcutta and of course or anywhere, and for false invoices were issued. So that again can be merit demerit. Now, what if such person is not now carrying on business? Of course, if he's not carrying on business, penalty, he 148 may not be issued to him for that year. Of course, if he carried on business, then 133(6) can be issued and penalty may be levied on him, because it's not essential to carry on business on such other person. Because for the person on whom the original penalty is levied, remember, for him, maintenance of books of account is essential. So therefore, he has to carry on business, because books of accounts are maintainable only in the case when assessee is carrying on business. But such other person, it does not talk about books of accounts. Therefore, it might be a problem. Whether such person will be get an opportunity of being heard, yes, of course, penalty has to be heard. What if the SSC files an appeal against the order of the under section and gets relief from the appellate authorities? Whether the person will also get a relief for the same? Yes. Of course, if a person is filing an appeal and relief is there, then the person also has to file an appeal and of course has to get a relief. 274 and 275 shall apply. opportunity of being heard is essential. Appealable jurisdiction, yes, it is appealable order, and jurisdiction is, of course, will depend upon the AO. So appeals are always on the CIT appeals depending on the jurisdictional AO, and therefore it will on the jurisdictional AO, or then they are referred normally to the CIT faceless. And if the cases of transfer pricing or the search, etc., then they are referred to the CITPs, which is not a faceless, which is done across the table on the hearing. Now let's talk about 270A, penalty for underreporting and misreporting of income. This again is a very interesting chapter. 1C as see 1C and double as A. The difference is that earlier the penalty was in respect of concealment of particulars of income or furnishing of inaccurate particulars of income. Remember, friends, it was not in concealment of income. It was in concealment of particulars of income or furnishing of inaccurate particulars of income. So earlier also, 1C, there was a lot of debate and a lot of case laws which had said, for example, even Reliance and all that said that my income may have been concealed. My income would have been enhanced, or addition would have been made, but my particulars were never concealed. So once my particulars were not concealed, the penalty was for concealment of particulars of income or furnishing of inaccurate. So I never furnished any inaccurate. Suppose I lodged a claim for 80 IC and I gave the proper particulars of the same. The department on certain reasons did not allow ATP. Then I did not furnish inaccurate particulars, so my claim was fine. It was not allowed, so penalty was not leviable because penalty was basically for furnishing of inaccurate particulars of income. So, or concealment of particulars of income, not concealment of income. So there is a distinction between concealment of income and concealment of particulars of income. So therefore, there was a distinction in 271C, and SR Meadows and Manju Natha, of course, at Supreme Court, they've gone categorically stating that now, for all earlier years, and all the tribunals and high courts are following, that the AO, while invoking a penalty under 271(1)(c) or issuing a notice for penalty under 271(1)(c), has to categorically state that whether the penalty was for concealment of particulars income or for furnishing of inaccurate. If he does not identify any one of the two and ticks both of them, the penalty is not leviable. There are a lot of judgments because normally the AO notices under 271(1)(c) were given by the AOs in a mechanical manner. They never used to identify whether they are going to levy penalty, or in the order used to say whether levying penalty on concealment of particular income or furnishing of inaccurate particulars. So there, of course, now the law of the land is very clear that if both either or are, if both the concepts are mentioned in the notice, means concealment of particulars and furnishing of inaccurate particulars, then no penalty will be levied because AO himself is not clear as to which limb of this section was applicable to this SC, and penalty will not be leviable. So all old cases in 1C which are going on where the AOs have not identified or ticked any one of these clauses, the penalty will not be leviable and one will get a relief. Now, probably to clarify that, or to another point why they talk about underreporting and misreporting, they have categorically stated is that earlier in 1C, there was a penalty which was leviable from 100% of the concealed income to 300% of concealed income. Now they have said that that was a very big discretion given and identification was not there. They have come to a clear-cut charge where it will be defined as underreporting of income or misreporting of income, stating that upon underreporting of income is charged at X rate of penalty, and misreporting, which is a bigger offense, is charged at a Y rate of penalty. So that is the reason why they have modified the sections. Of course, AO has still discretion under subsection 1. The AO assessing officer may, during the course of any proceeding under this act. Now, even 271AAD, also they have a discretion. The word may is there, but again, there are a lot of interpretations with whether, if all the conditions, suppose a fake invoice is actually received or an omission is actually found, then if a fake invoice is actually received and it is entered and is justified and seen that basically a fake invoice was issued and the assessee was hand in glove and the a part of their acting, then the may has to be read as shall, and therefore penalty would be levied. AO may not have a discretion there. In fact, a lot of cases of 271 AAB also are coming, where this problem of undisclosed income is coming, where in Supreme Court in one of the cases they have said that may has to be read as shall. In Sandeep Chandak's case, of course, that is distinguished in subsequent cases, not by Supreme Court but by the other courts. This 270 of course, the assessing officer, the commissioner appeals, or the principal commissioner or commissioner name. See, the difference in 271 AAD is there it is the assessing officer or the commissioner appeals now, not the principal commissioner. Here, principal commissioner, which means under 263 also. During course of any proceeding under this act, direct that a person who has underreported his income shall be liable to pay a penalty, which means that under 263, 271 AAD direction cannot come because the principal commissioner cannot direct there because he is not part of that section. So 270 AAD is restricted only to the commissioner of income on the assessing officer and the CIT appeals, whereas 270A is to the assessing officer, CIT appeals, as well as principal commissioner who has underreported his income shall be liable to a penalty. Now subsection 2 defines underreporting, specific instances covered under the concept of underreporting. Any proceedings I have already talked about: assessment, reassessment, rectification, revision, etc. For 270A, the AO will have to divide the addition to 3 parts: an addition not amounting to underreporting with no penalty, an addition amount to underreporting where there is a penalty, and an addition amount to misreporting. So underreport 3 parts are there when the categorically in the assessing. See, now let's talk about assessing officer passing an assessment order. Now, suppose it's a large assessment order and there are certain additions. Now, in those additions, the AO will have to categorically say that this addition is because when we go through the subsection, as the sections and subsections, we'll come to understand that these are the cases where they may be underreporting, but there is no penalty. These are the cases where there is underreporting and penalty is leviable. And these are the cases which are underreporting amounting to misreporting where penalty is provided. So an order may have 3 parts. All 3 parts may be underreporting. One underreporting is only underreporting, no penalty. The other is underreporting and penalty of underreporting. And the third is underreporting resulting in, as a consequence, basically, which is consequentially a misreporting and therefore difference, because the rates of all these 3 are different. So therefore, one has to be very clear. And again, to my mind, of course, I've covered later, but satisfaction of the AO would be there, and in Manjunatha, as our Supreme Court, as we have discussed, would come into play, because here again, unless until there's a very good judgment of Delhi High Court I've discussed later on, and then this class where they have categorically said that AO will have to say whether it's underreporting or misreporting of income. And then again, Supreme Court, when you talk about this concealment of particulars of income or punishing of income, because if none of them are marked, then the penalty should be dropped. That could come to rescue in this case as well. When can prosecution? Of course, no penalty, no prosecution. Where there's a misreporting, only then prosecution can be launched. So therefore, underreporting, there can be no prosecution. And 6, a person shall be considered to have underreported under 6 clauses. Let us come to what are the clauses. The assessed income is greater than the income processed under 143(1)(a). So, what is that? Assessed income is greater than income processed under very, very, very important is that is greater than income processed under section 143(1)(a). So now let us come to this. If a returned income is 5 lakhs, income determined under 143(1)(a) is 5 lakhs, assessed income is 10 lakhs. The penalty may be imposed on 5 lakhs because 143 is same. But now 143 determination is 7 lakhs and assessed income is 10 lakhs. Then the penalty basically will be only on 3 lakhs. Now, third case is assessed income and income determined under section 143(1)(a) is same, but my returned income was less. So where the adjustment is done only in respect of 143(1)(a), no penalty will be leviable under 270(a), which earlier used to be levied. Now, which means that any adjustments which have been done by the department, or which should have been done by the department, In fact, we can take a plea when we go to 143(1)(a). 143(1)(a) adjustment up to 16-17 were very less, but now let us come to AOI 17-18 onwards. We can take a plea that adjustments ought to have been done. Suppose an adjustment has not been done under 143(1)(a) and an addition is done by the AO. So we can take a plea, sir, in respect of these clauses, the adjustment should have been done by the AO, and he is not done, by the CPC under 143(1)(a), and they have not been done, and therefore addition will not amount to penalty, because it's categorically saying assessed income is greater than income processed under 143(1)(a). So if a processing error has been done, then of course that rectification has to be done if the AO is levying a penalty. Now, what are the adjustments which are permitted as per law now? The disallowance of loss claimed if the return of previous year which set off of loss is claimed was furnished beyond the date specified. So if I have taken an incorrect loss, disallowance of expenditure indicated in the audit report, not taken into account in computing the total income. Now, it's just like we talk about PwC. Or for example, 36(1)(5)(a), which is coming, payment of PF, ICAI, and all those things, which basically are expenditure indicated in the audit report and not taken into account in computing total income of the return. These adjustments are mandatorily adjustment under 143(1)(a). So if the 143(1)(a) has not made any adjustments and the AO has disallowed such expenditure, he cannot levy penalty under 270(a) because this is a disallowance under 143(1)(a), and the penalty is only on the difference of assessed income and income as per 143(1)(a). Similarly, disallowance of a deduction payment under section 10AA, 80IB, 80IE if the return is furnished beyond the due dates. Now, I have seen several cases where we have seen, or we are contesting that 80IA, the return was, of course, now the tribunal is quite clear, but 80IA report was filed beyond the due date and deduction should not be allowed. So suppose it has not been adjusted under 143(1)(a) and AO levies a penalty, you can have a rescue. Another issue is addition of income appearing in, this is a very important issue, addition of income appearing in 26AS or Form 16 or Form 16 which has not been included in computer. Lot of cases under 148 now which have come up, say for assessment year 18, 19, 19, 20 or 17, 18, where it is categorical that there is a mismatch between 26AS, it's a flagging between 26AS and the assessee's return. Now in those cases, suppose I have shown an income of 1 lakh rupees, whereas my 26AS shows that TDS has been deducted on 5 lakh rupees. So basically the department is saying that, okay, you have shown 4 lakh rupees as less income because 26AS reflects 5 lakhs, whereas you filed a return of 1 lakh rupees. So there again, if the AO makes if 143(1)(a) adjustment is not there, and if AO makes an addition of 4 lakhs, so can a penalty be leviable under section 270(a)? I would again contest here that the assessed income is greater than income processed under 143(a). Income processed under 143(a), to my mind, because they are clauses part of 143(1)(a), therefore income processed implies income processed or should have been processed. For example, if there's a mistake in processing by the department, then that mistake ought to have been rectified, and that once that mistake is part of 143(a)(1)(a) processing, then penalties should not be leviable because penalty actually is not leviable on processing 143, and this is a categorical clause under section 143(1)(a). So therefore, in 26A AS mismatch and all, we may have a case saying that penalty is not leviable because most of the 148 cases which are coming up on mismatch. Now, the income, second part is the income assessed is greater than maximum amount chargeable tax where no return is filed by the SSC. Therefore, greater amount than maximum amount chargeable tax where no. Let's come to the cases XLP, a paid advance tax of rupees 11 lakhs. The balance sheet prepared but no return was filed. The difference profit is 2 lakhs. What would be the penalty? It is a paid advance tax 1 lakhs and profit of 2 lakhs. Penalty basically shall be leviable even if the income assessed is not shown in the balance sheet because more balance sheet, because Just a second. So penalty shall be leviable even if the income is assessed at the profit shown in the balance sheet, because earlier, an explanation 4 was there to the rescue, which used to say that if advance tax has been paid, then explanation 3 of the section where advance tax has been paid, then difference of course would be to your benefit and you will not be liable to pay tax penalty to that extent. But now whether you paid advance tax or not, it does not matter. Now let us talk about salaried employee. A TDS has been deducted on income tax of rupees 20 lakhs. Return not filed. Income assessed at 20 lakhs. Because he has not filed a return, his income was 20 lakhs and TDS was actually deducted on tax 20 lakhs. But the SSC has not filed a return of income. Now, income AO assesses income, issues 142.1, you file a return, and then of course it assesses it over 20 lakhs. Penalty will be on 20 lakhs minus income not charged, which is 17.5 lakhs, despite the fact that the entire TDS has been deducted on his income. So it is actually unfortunate that he's just not filing. We see the extent of problem which are going to arise on non-filing of returns, even for a salaried employee. If a salaried employee is not filing return and subsequently assessed, then he will be liable to a penalty on the entire TDS. Tax, of course, will not be payable because TDS has already been deducted. But penalty will be payable in 270A because the return was not filed. So that is again a very draconian provision as far as when non-filing of return. Now another interesting issue, which is against the SSC. Let's come to this. An individual files his return of 1 lakh rupees and assessed at 3 lakh rupees. So penalty on 2 lakh rupees because the difference of return and assessed income. Now, if he does not file a return on the same case, then the penalty is only on 50,000, because what does it say? If no return is filed, it says if no, of course, it's basically it's just a second. Yeah, consider to have six assessed income greater than income. The other's income is or assessed is greater than maximum amount not chargeable to tax, where no returns filed with SSC. So when no returns filed with SSC, in this case, his income assessed is 3 lakh and he has not filed his return, the penalty will only be in respect of 50,000 rupees. Whereas if he files his return of rupees 1 lakh rupees and assesses 3 lakhs, the penalty on 2 lakh rupees, which means is he getting a benefit of non-filing of return? So it is a both way sword. It can be for the benefit as well as for the demerit of the SSC is concerned. Third clause is where the income assessed is greater than the income assessed or reassessed immediately before assessment. Of course, basically this is for reassessment. As many times reassessment takes place, the previous assessment would be the benchmark and the penalty on differential would be calculated. Where the deemed income, total income assessed or reassessed is greater than deemed income under 143(1)(a), that is basically covering the 115 JB. Where again 115 JB is greater than basically again reassessment, and income assessed or reassessed is the effect of reducing the loss or converting such loss into income. So where here again, where the income assessed or reassessed has the effect of reducing the loss or converting such loss into income. Here, just like earlier, 270 explanation was not there, but the Supreme Court by finally interpreted that reducing the loss to income or the differential loss will be liable to penalty. Suppose the loss is 5 lakh rupees, it has reduced to 2.5 lakh rupees, then the penalty will be taken at 2.5 lakh rupees. 270 is the underreported, taxable at 115 JB, say 100 lakhs, taxable as per normal 30 lakhs, additions made 20 lakhs. Now, see what the effect of the sections is that if the income and if you calculate the underreported income, if as per 115 JB, the taxable income was 100 lakhs, and as per normal provisions, the income taxable was 30 lakhs, so additions of 20 lakhs were made, which affected 5 lakh 115 JB and of course 30 lakhs means because original return was there because 30 and 20. So with the I mean assessed at 50 lakhs with additions of 20 lakhs means normal assessment is at 50 lakhs. So under reporting will be 50 minus 30 and 105 minus 100 in respect of 115 JB. So that is the basically sum and substance of the earlier section which I said. Although it amount to double tax, but of course this is the sum and substance of the provision of the tax, how to calculate the under reporting of income. Case study, loss to loss income of current year. Carry forward loss 30 lakhs, returned income nil, addition of 10 lakhs. So at taxable income nil. Now what is happening is that, see, interesting point is whether interpreting of law, whether the income assessed or reassessed has the effect of reducing the loss or converting the loss into income. So where there is I was just reading one of the articles which a person is very, of course it's a far-fetched interpretation, but it is an interpretation which says where the income assessed has the effect of reducing the loss, which means the loss is reduced, means one loss to another loss, or converting such loss into income. So if a loss comes to nil, whether it be applicable or not, carry forward, suppose the income was 10 lakhs and carry forward loss 30 lakhs. So loss has been reduced to nil. So there's no reduction of loss. Basically the income has become nil. So whether penalty will be leviable, of course, said. Another issue is loss of rupees 5 lakhs. In case of individual, reduced to 2.5 lakhs. Here there will be no penalty as such because loss of 5 lakhs has been reduced to 2.5 lakhs. It says that maximum, it will be the benefit will be to the extent of maximum not chargeable to tax. So penalty on 2,50,000 is an exemption for individuals. Therefore, in case of individual, if the loss is 5 lakhs and it is reduced to 2.5 lakhs, penalty will not be leviable. See, again, as I said earlier, in case where the assessment or reassessment has the effect of reducing the loss declared in the return or converting that loss into income, the amount of underreported income shall be difference between the loss claimed and the income or loss, as the case may be assessed or reassessed. So, with loss claimed and income or loss assessed, it does not talk about nil. So, it says income or loss as the case may be. So, therefore, the interpretation was whether it is in the case of a nil, because nil means neither income nor loss. So whether penalty will be leviable, and that is the reason why I said that penalty may not be leviable where it is converted to a nil. Now let's come to 270A6 where penalty is not leviable. 270A6 is very categorical because I said that they wanted to clarify that whether it is one has to take 271C and where the benefit should go on to SSE. Let's see part A, the additions or disallowance in respect of which SSE offers a bona fide. We had discussed earlier in the very beginning in the case of Price Waterhouse, which says a bona fide explanation to the satisfaction of the tax authority. So there the Supreme Court has said that even a silly mistake from a person like PwC can be a bona fide mistake because it is not expected to do such a silly mistake. It has to only be a bona fide mistake. It cannot be a mala fide mistake. So therefore, bona fide explanation to the satisfaction of the tax authority and proves that he has disclosed all material facts to substantiate the explanation. All material facts, of course, is a definition. Because then again, it's a discretion of the AO. What is a material fact? We can go into several case laws explaining what is material facts and what is substantiation also. There are several case laws. I'm not going to go into that, but of course, the onus is now on the SSE. Penalty could be leviable only on routine disallowances, say a car running if the SSE does not maintain a logbook. Routine disallowances, it will be difficult for AO to live at AO level because they will be disallowing, and then how can he be satisfied? See, now let us come to this. If an AO, let us come to this addition or disallowance in respect of SSE offers a bona fide explanation to the section of the assessing officer. Let us say, isn't it self-contradictory? If there is an addition or disallowance and it's a bona fide explanation to the satisfaction of the AO and proves that he has given all material facts, then where will be the disallowance? If it's a bona fide addition, this of course means 40A3 etc. or sorry 40A IA or 36(1)(5)(a), etc. could be there. But other than that, I just don't feel for expenses as such. An AO could say, I am disallowing it, I'm satisfied with all material facts. It cannot be there. So it is only a very, very few cases which could be part of this section. It will be difficult for the AO level because he will be disallowing, and then how can he be satisfied with the explanation of the SSE? The conditions required to be cumulatively satisfied are the SSE offers an explanation, the specified authority is satisfied the explanation is bona fide, and the SSE has disclosed all material facts to substantiate the explanation. Material fact, of course, a fact which is really important to a reasonable person in deciding whether to engage or not to engage in a particular transaction. An important fact as distinguished from some other important trivial detail. Rajasthan High Court has said that following the material fact means the facts necessary to formulate a complete cause of action or preliminary facts which must be proved by the party to establish. It's a very cumbersome process to justify to that all material facts have been given or not. Now come to the second limb. It says the addition, which where again penalty will not be leviable. The additions or disallowances determined on estimate basis. If the account maintained SSE and correct and complete to the satisfaction of the tax authority, but method employed is such that income cannot be properly deduced. Which means that suppose additions or disallowances are determined on estimate basis and the accounts are maintained by SSE are correct and complete to the satisfaction. Suppose there is a disallowance, the AO estimates disallowance, he does not reject my books of accounts and he says GP, because last year was higher, this year is lower, addition on account of GP on certain estimates, or 1 lakh addition on GP or 2 lakhs addition on anything, there again the penalty cannot be leviable. It is categorical here. Here, when the books are rejected due to the fact that they are not correct and complete, the penalty could be leviable. Where addition is made in respect of GP just because of reason that the same is low, because he says that maintain SSE are correct and complete. So which means if there is a rejection of books of accounts, then underreporting would be applicable. And of course, there misreporting could be also be applicable when you go to the misreporting section. But again, here books are rejected, then penalty would be leviable. But if books are not rejected, then it will not be leviable. Where additions are made in respect of GP, as I said, just because of reason the lower GP or merely because stock records are not maintained, penalty would not be leviable. Say valuation of stocks, percentage completion method, ICDS cases, even percentage completion method in ICDA cases, plus completed project or percentage completion. Again, there are a lot of judgments which are saying that both of them can be followed. C. The additions or disallowances determined on estimate basis whether SSE has suo motu made a lower amount of disallowance on the same issue in the computation of income and has disclosed all material facts of such additions. There are two conditions. A, lower amount of disallowance on the same issue and disclose all material facts. For example, 14A or say personal expenses, disallowance of car expenses, etc. Material facts again as taken from judgments, which I have said, but certain disallowances are made by the AO, by the SSE himself, and the AO enhances this disallowance. There again, penalties will not be leviable. Say household expenses in individual cases, a lot of additions are made at times. So though there, of course, all personal expenses in car, for example, in a firm, there's certain personal expenses of the partners which are disallowed. If a certain part is disallowed by an SSE himself, and AO enhances, then of course, the penalty would not be leviable. These are adjustments related to TPO, and the last one is basically amount of undisclosed income, because undisclosed income is already covered under 271 AA. So there's separate penalty provisions. Basically, that is only in respect of search cases. So in search cases, penalty under 270A will not be leviable. 271 AA of the search cases is only in respect of the broken period, which means the year in which the search is conducted, or the year in which the search, the return was not due and not filed. For example, if a search is conducted today, then 271 AA will be applicable for the current year, which means financial year 22-23, and also for the financial year 21-22, because there is a return of that year is still not due. So therefore 271 AA in some cases will be only for 1 year, in some cases it can be for 2 years. So in such cases, only penalty under 271 AA will be there and not under 270A. And not so on misreporting directly. Misreporting has been defined in subsections 2 of this 9 of the subsection 270. A combined reading of these subsections reveal that misreporting will be where underreporting of income is because of the following circumstances. It starts with thus restrictive only to a misreporting or suppression of facts, which means there is a misrepresentation or suppression of facts. I have misrepresented my facts or I have suppressed. Again, here there should be a positive act of suppression on the part of the SSE. Onus is on the department. Failure to record books of accounts, investments in the books of accounts. Of course, where no books of accounts are required to be maintained, then not covered. Sent in the 44 AD. And with section 69, what will be the position? Now, failure to record investments in books of accounts, which means there have to be books of accounts as far as investments are concerned. Third is claim of expenditure not substantiated by any evidence as against wrong claims, which Reliance comes to rescue. It will be difficult here. In several cases, there is no evidence as regards expenses. In several trades, for example, bills are not available on our self-made vouchers. Now, not substantiated by claim of any expenditure, not substantiated by any evidence. I think here again a mens rea will have to be proved, because lot of genuine instances, because see, there are a lot of judgments which say there's a trade practice. There are a lot of judgments which say that, of course, there's that it is a secret commission was paid, etc., etc. So there's a trade practice, which means again here, because it's such a misreporting, there has to be some positive act on the part of the AO to say that I had booked this expenditure in a malafide way and I could not substantiate it by any evidence. There only it will come under misreporting. Else, of course, it may come under underreporting, which can be there. Records of false entry in the books of accounts. Now 271. Now here I was discussing the exact same wordings are recording of false entry in the books of accounts. Similar wordings are 270 AAD also. So double penalties will be levied. Now, a lot of times we find that persons are issuing, putting suppose fake, because 271, let's come to 271 AAD, and here also. Suppose certain salaries are booked and services are not rendered, or certain commissions are booked and services are not rendered. So all those entries where commissions are booked, commissions agreement is there, and finally it is found or under statement of 131.1 or 1A or wherever, that actually the commission was booked and the SSE as an expenditure, but the services were not rendered. Similarly, there would be cases where salaries would have been debited, but services are not rendered. So in such cases, 271 AAD and 270A misreporting, both will be applicable. So therefore, one will have to be very careful as far as now talking about recording of entries in the books of accounts and then substantiating that by evidence and ensuring that basically these are not false entries, because once the AO proves that basically those entries were false and they were therefore reduction of income, we'll have a double jeopardy. Failure to record any receipt in the accounts having a bearing, again exact same wording the 271 AAD. There again it had said omission of an entry to avoid tax, to having an impact on total income. Here again it is failure to record any books of accounts having an impact on the total income. So of course it has to be books of accounts and bearing on total income. Therefore, let us see when here again, as I was talking about the on money case, here again it will be exactly similar. Failure to record any receipt in the books of accounts having a bearing on total income. At 270A, it will be misreporting of income. So therefore, one has to ensure all these entries will now, from 2020, 1420 onwards, 1420 transactions which have taken place after 1420, because 1420 means 2021 financial year, assessment year 21-22. As such, as of now, till now, the cases have not been done. And once the cases are done, then penalty under 271 AAD would be leviable. So therefore, ensure when the cases are being done under 271 AAD, for these assessment years, and there are means, because now if it's in a faceless regime, suppose there's a notice of an AO which says that bogus purchases are found or bogus sales are found or things like that, or any from any other income or a substantiated income, one has to be very careful in giving the replies, because as soon as misreporting is covered under these two clauses, similar additions would be similar penalty would be levied under 271 AAD, because that again starts the non-obstante clause. So there will be double penalty here. 200% of the tax sought to be evaded, and there 100% of the transaction value. So therefore, one has to be very careful as far as these provisions are concerned. Sixth is failure to report any international transaction or deemed international transaction or any specified domestic transaction which provide for Chapter 10 applies. So failure to report any international transaction or deemed international transaction is liable to misreporting of income. Provision of 274 and 5, of course, are basically in consonance with earlier provisions, which primarily I would summarize as that if I take a benefit of any earlier edition, which means suppose I say that I had a cash credit in the 2 years back or 3 years back, and penalty is being levied today, I say that that is basically coming out of 2 years back. So the penalty can be leviable in that year in respect to that cash credit. So therefore, taking a telescoping of earlier edition or earlier where penalty was not leviable, if I have a risk, explanation 2 of 271C was already there, which covered these cases. Now let us come to the penalties. Penalties levied at 50% of the tax payable income which has been underreported, and 200% of the tax payable income which is misreported. So underreporting is 50% of the tax payable, and misreporting is 200% of the tax payable. So therefore, to that extent, it is comparatively easier than 271(1)(c), because a lot of cases, including 143 1A adjustment and certain cases of underreporting, have been eliminated from the penalty. Certain cases are now brought only at 50% regime, and now other cases which are actually a malafide, which was 1C earlier, have brought under 200%, where in 1C there was a discretion of 100 to 300%. So they have taken a mean, and they are mean, of course, average. They have taken a mean of 200%, and they are talking about penalty leviable on 200 at the rate of 200% of tax payable. And tax payable has to be calculated in subsection 3 and 10. Tax payable in respect to underreporting, when no return are being furnished and the income has been assessed for the first time, the amount of tax credited underreporting income has increased by maximum amount not chargeable to tax. So of course, in companies it will be blanket 30%, because the maximum amount not chargeable to tax in companies and LLPs is 0, or the firms. Individual HUL will have the benefit of tax slab. Of course, these are, one can go through the, I'll not go through the calculation of penalties. Now, in case of deeming fiction, 50C 14A additions made, whether leviable, of course, fictions 50C and 14A, to my mind, of course, it's a bona fide fiction, then 1C per se was not leviable. Here again, I think these fictions, if we categorically, we have got a bona fide case, or we have made some lump sum addition, or we have categorically stated, because 50C per se is a contesting thing, because I am contesting, I have filed a lesser return than the stamp duty value, and I have to give it to the DVO. The DVO may be there or may not be there. So therefore, I am not I am under bona fide belief that I will get a benefit from the DVO, or even otherwise, I am categorical that whatever the price I have stated in the sale deed is the correct price. I am not restrictive, nor the department has found that I have taken anything over and above cash. So just like KP Varghese case, Supreme Court, which they have categorically stated, and why these sections were brought in. So therefore, to my mind, there will be penalty not be levied. Protective penalty is not permissible as per law. Satisfaction, as I discussed already, whether underreporting, misreporting of income has to be stated on 1C. Yes, to my mind, because both, as I said, there are three provisions, three circumstances. A, underreporting not resulting in penalty, underreporting resulting in 50%, and underreporting leading to misreporting resulting 200%. So therefore, the order has to be categorical. And Delhi High Court very recently in Schneider Electric writ petition quashes order rejecting immunity under 270AA4 and directs revenue to grant immunity from penalty under 270. High Court holds, important is, High Court holds that revenue merely stating misreporting of income in the assessment order to deny immunity from imposition of penalty, which is manifestly arbitrary, and failed to show which limb of section 270A got attracted in SSC's case and how ingredient of section 278(9) got satisfied. So this Delhi High Court categorically states, as states in Manjunatha and S.A. Meadows, where confirmed by Supreme Court, that the limb will have to be categorically stated by the AO in the order and while drawing a satisfaction that whether it is a underreporting or it is a misreporting. So there again, one has to be very categorical. 270AA again is an immunity from 270A. Tax and interest payable as specified in the notice of demand in persons of order with assessment within the time limit if we pay the interest, tax and interest as desired in the notice of demand in person of order assessment within the time specified and no appeal is filed, then the AO, the procedure is the assessee is required to file an application the time prescribed within 1 month. Assessing officer is conditions fulfilled shall grant imposition from penalty and prosecution. Remember, this is only in respect of underreporting of income. It is not in respect of misreporting of income. And AO shall pass an order within 1 month from the end of the month in which such application is received. The AO shall give, if AO does not give the benefit of this section, then he has to give an opportunity of hearing to the assessee why he is not letting me benefit of 271AA procedure. Sorry. Now, I was talking about the case study. Sorry. An individual not maintaining proper books of accounts, seeks an immovable property on 18/2/20 with the following consideration: amount received through regular banking charges 50 lakhs, amount received in cash on money 50 lakhs, stamp duty value on property was 50 lakhs, amount paid to broker in cash 2 lakhs. Detection is made in the course of search at the SSC's premises, which means I am an individual. Amount received, SSC received, of course, received through banking. I have sold the property, and I have received through check 50 lakhs, and I have received on money of 50 lakhs in cash. Stamp duty was 50 lakhs, so I have received, as far as 50C is concerned or 56(2)(10) is concerned, there is no violation. Amount paid to broker in cash unexplained is 2 lakhs. Now let us come to see what can be the penalties. 271DA regarding 269ST, because he received 50 lakhs in cash. So once he received 50 lakhs in cash, penalty would be leviable. 271AA, not an unexplained cash credit, because books of accounts are not maintained. So therefore 271AA will not be approved. It will not be 115B will not be applying here. 271AA, not applicable since books of accounts not maintained. Section 270A, not applicable in search case because it's a search case, and section 271AA will be applicable. So what I'm saying is penalty is now, penalty by itself has become a very important chapter, and we will have to also ensure, because now AOs may make a lot of mistakes, because in a single case there can be 4 different subsections of penalties, 4 separate sections of penalties which can apply. So the AO may mistake a mistake, and we can take that benefit of the mistake and seeing that whether correct provisions are applied or not. Now in the same case where the SSC was a company, the search was a company, received 50 lakhs on sale of land, 271DA as will be applicable. 271 AAC is not applicable, but because it is not an unexplained cash credit, since it was never credited in the books of accounts. So now, because it was not credited in the books of accounts, it was not an unexplained credit. So therefore, 115 BBE will not be applicable. But of course, if certain documents of utilization of that on money, for example, I had that on money, I received that on money in cash, and that on money was applied for purchasing another land. So it may be an unexplained credit and then unexplained expenditure because if or whatever company, because if it's in business or real estate, then 69 or 69C can apply and 271 AAC, 115 BBE could be applicable. 2 under section AAD is directly applicable since I have maintained books of accounts, I am a company, and that on money was not recorded in the company. So 271 AAD will be applicable. 270 as I said will not be applicable, and 271 AAB will be applicable because it's a search case. AAD on the broker could also be levied, as I said, because he was a middleman who was a part. He was, because it's such in 271 AAD says such a person in any way is responsible for this transaction. So the broker can also be levied the penalty on the full amount which is leviable for penalty under 271 AAD. A broker may get only 2% of the brokerage or 1% of the brokerage, but the penalty could be on the entire amount. Now, another case is daily wages, labor expenses, daily wage attendance, which is normal, very normal. Disallowance of 5% for want of verification, Getty and Moran. Is basically if a builder has incurred certain expenses, he buys Gitties and Moran of self-aid vouchers, 7 crores and 5% for want of verification is disallowed. The case 1, AO did not reject books of accounts of SSC. AO rejected the books of accounts of SSC, and third, AO rejects the books of accounts of SSC and the SSCs are able to substantiate its claims. An addition of 12 crore is made. So there are 3 situations of the similar case, which is a very normal case. Case 1, applicable to 270A, AO made an estimated addition to the books of accounts. As such, it is an exclusion and 270A will not be leviable because it says that he has made an estimated addition and not rejected the books of accounts. Case 2, case 1, of course, has a resolution of false, therefore not be penalized in 271 AAD also, because once AO's estimated and he is not talking about false entry, therefore AAD will not be leviable. Case 2, 270A may be imposed because the books have been rejected. 271 AD may also be applicable, but the quantum should be restricted to the amount of disallowed. Of course, again 270 AD may not be applicable also if I am able to prove that there was no mens rea, no mala fide, I was not able to substantiate my expenditure. So 271 AD may not be applicable, 270A will be imposed. Case 3 now, and the entire 12 crores have been added, and I have not been able to substantiate those expenses. So here, under is misreporting of income is direct. In earlier case, it would be underreporting. In this case, it would be misreporting, and 271 AD shall also be applicable on the entire quantum expenses, because I am unable to substantiate the expenses, which means there may be false entries or false vouchers. I am unable to substantiate any of the expenditures made. Once I am unable to substantiate any of the expenditure means, which basically it's false, the onus was lying on me. It was proved beyond doubt that there were entries which are false. He's giving the show cause, and therefore 271 AAD may be also be applicable in such a case. This, of course, I have discussed during the course as well. Here I was discussing, I think, survey in the cases when I was talking about exports made and the parties not existing, and GST department said that in such cases it will be very, very difficult, because I had certain such cases wherein the department, on the basis of investigation of Wing of Bombay, stated that certain diamond merchants were not existing at their addresses shown, and they were only book entries, and the GST authority, of course, at that time, VAT authorities in their portal said these parties were issuing fake invoices. But whereas in my case, I got the invoices, I got the delivery of the material from that party, and finally my goods were exported as far as diamonds were concerned. There was a custom stamping on that, So, which means I had physically exported the diamond. So, it implies is, it implies thereof is that, so suppose I was giving just an example. If you are a company and you are going to a shop to buy a computer, so Value Plus to any store for that matter, and if you go to the store and you buy a computer from there, a laptop from there, and take a bill from there. Suppose you take a bill from there and they give you a bill not on the name of the store, but XYZ company, and they give you a regular bill, which is a GST invoice. They give the GST number also, and you don't never see the board outside the shop and the bill name of the bill which is written there. It could be different. Now they give you a different bill, which is actually not the name of the shop. They have the GST number. They take to an account pay check, and then you are paid by account pay check, and you take the delivery of the computer and come to your office. Now, suppose that person vendor which was issuing a bill has another concern wherein he was issuing certain invoices, and finally he was not showing a purchase or whatever the reason, it was a fake invoice which was there. How are you at fault? Because you had gone there, you had bought that, you had got a GST invoice, GST number was written in that, or of course you may not be claiming GST credit for that, of course, but because it might not be reflected in your GST returns. But then how are you liable to that? So for the fake entries? But again, this is good. This is basically going to be a big problem, because there are a lot of persons who are issuing invoices, some concern, and basically having several concerns of the business, and they may be issuing fake invoices. Here again, probably this is the first case I was discussing. Yeah. In the course of survey of the SSC premises on so-and-so physical stocks were found to be short of books of account, the SSC admitted to have entered some sale bills. They also found certain fake purchases which are entered in the books of account. They immediately, AO immediately on the books of account admission of the SSC issued show cause and 270 of the Act and approached you to advise on selling. Since assessment of the SSC case would happen only after 32(9), of course, such was 92, whether notice under 180 was valid. After the survey, SSC has accounted for the sales in the books of accounts and thus would include the same in the tax income, whether this is a reasonable cause, whether department could also impose penalty under 270A. AAD means proceedings under the Act. So therefore, as such, it can be levied at any point of time. However, unaccounted sales were made on 20th April and the date of filing of GST returns. So payment of advance income tax was not yet due. Therefore, it could be argued that same were only inadvertent omission. It was not an omission to evade tax. So there one can get a benefit. There is nothing to prove that there was not an intent to evade tax, to suppress taxable income. As regards purchase invoice, the same were covered definitely under false entry in provision 271 AAD would be applicable. Of course, this I'll leave with this paper, this presentation, so you can go through that. Yeah, this I already discussed. Three companies having circulating invoices having common order, the drastic impacts of this which can come. In the course of labor inspection, the premises of Mr. Electrical, several employees were found to be not to be existing, and thus not compliant with ESIC and PF laws. Mr. Perfect made a payment of 5 lakhs toward ESIC. Subsequently, at the time of assessment proceedings, 143, the AO made addition of 40 lakhs of their unexplained expenditure towards unaccounted labor charges. Of course, there were certain employees which were there, but ESIC and PF was not paid on them. 5 lakhs of rupees was basically paid toward the SICPF by way of penalty. The AO initiated penalty proceeding 271A, 270A, AAD, and 27AAC. The SSC has approached you for advice. 270 AC is a specific section imposing penalty in respect of 69 to 60. Thus, see, it is unexplained expenditure. And once an expenditure is made out of cash, 115 BBE will be applicable, and penalty under 69, 271 AC will be applicable. Subsection 2 of section 270 AC specifically excludes amounts of penalty under 270A. Thus, 270A will not be applicable. 270A double AD will not be applicable because there is neither a false entry. It's not a false entry because there is no entry as such. There is an expenditure which is not entered. So there's no false entry. And the omission, the important is that omission in this case does not result in reduction of taxable income. It does result in taxable income. Whereas the loss is where the omission results in enhancement of income, which means that omission actually is done to evade tax. Here, omission is not done. Basically, it's an expenditure has been avoided. So therefore, had this expenditure we put, the tax would have been reduced. So in such case, 271 AD will not be applicable. So one has to go on case-to-case basis where AD will be applicable or not. Again, I think I'm running out of time certain cases. So I think if we have certain questions, we'll put on questions rather than again the case studies, because
So can we take up the questions, sir, or else how is it?
I think questions you can be taken on because the case study is certain there more. I think running out of time, we can have questions if
Sure,
there.
there are some questions, sir. So I'll
Yeah.
just display it on the screen. 1 minute, I'll take the rights and I'll display it on the screen. So I'm just sharing my screen. Okay.
Yeah.
So my Excel sheet will be visible to you, sir.
Yeah.
So this is the first one.
Yeah.
You can maximize the window and you can see it because.
Yeah, I love that.
Double click on the screen.
Would GSTR1 be a proof of existence of a supplier? Friend, well, of course, I personally feel GSTR1 could be a proof of the supplier per se. There are a lot of cases where GSTR1 is there and the supplier do not exist because actually the section has been introduced stating that there are certain racketeers who are there. So suppose there is GSTR1 is there and suppose it is a part of a racket, then double AD will be applicable. So that will not be basically a proof for existence of a supplier. It can be a proof. It can be part of a racket as well because there are a lot of GSTR ones which are there, and of course will be part of the racket. Is the penalty you are speaking about non-audit cases only when returns are held to be filed by the advocate? No. I think penalty is basically for all the cases where only returns are held to be filed. See, I personally feel is that the penalty per se, when I'm talking about 271 AAD, is basically in respect of all cases. In fact, it is more into audit cases where fake invoices are found. And suppose a fake invoice is found or fake transactions are found, and basically where there is a professional involved, it is a chartered accountant involved or anybody is involved, then in that case, penalty of fake invoices will be leviable. And where it is proved that suppose an example that certain services are rendered, certain commission is certain commission is put debited in the profit loss account, and services are not rendered. It is an audit case, and ultimately it comes to the notice through SIRC or anywhere that has been arranged through a professional who has arranged this, or for example any false entry has been arranged professional. So therefore in all the audit cases the professional will also be liable to penalty as well as this. So therefore this penalty is basically more of an audit cases rather than non-audit cases, because 44 AD may get a relief, but audit cases will always be there where penalty would be applicable. In the case of SIRC, undisclosed income and assets are found as SEC except the same under 132(4). See, yes, undisclosed income and assets are found and except under 132(4), liable to penalty in addition to penalty, yes, because as such there is no rescue under 271 AAD regarding 271 AAB. So therefore, if it is found and certain expenses, of course, basically it's a fake. Let's again come to 271 AAD. It's fake invoices or omission. So concealment of stocks, if it is relating to certain fake invoices and omissions, then of course it could be there. But if it's purely an undisclosed income during course of search, it is an undisclosed income, then 271 AAB is not will not be liable. Now, a very good question is 271 AA pertaining to search is discretion or mandatory. See, I would again, I had taken the other slide also. It is very important that 271 AAB is basically, to my mind, it is discretionary. Although in Sandeep Chanda case in Supreme Court, it relating to in fact Allahabad High Court, they was I don't know, they had argued sort of that it is an automatic penalty, but I would say it is discretionary because the word used in 271(1)(8) AAB is basically question of that whether it's undisclosed income. And undisclosed income per se, if you go through the explanation, undisclosed income is basically an income which is found during the course as an action of search. Example, suppose during the course of search, certain things have been found, and which are on which, of course, 271 AAB penalty may be levied. But certain things I have disclosed which are not found. Let us come to this: stocks. Excess stocks were not found, or excess building construction was not found. But I said that okay, and I done that. So that case, AAD will not be levied. So therefore, to my mind, it is discretionary and not mandatory. In the assessment order passed by AO for 1819 March 21, AO initiate penalty under for 1819 section was not available. Can AO take a stand? Penalty section was wrong. No, I don't think so. Because once he has taken a penalty, see, satisfaction of day is important. If or 292 BB cannot be taken for wrong sections, because the law is very categorical. Any section which goes to the root of the section or the root initiation, if cannot be amended by the EO subsequently. So AO cannot take a stand that it was a wrong section was wrong. He cannot take a stand. Now the AY to be read to 1415 and the AY to be read as AY 1415 and not AY 1819. The order was passed in the 147 date of 148. I just unable to understand. It's probably related to the earlier question. I'm unable to understand only this question per se. In the penalty, I'm unable to understand this question, please. Of course, the next question is the penalty of AAC is discretionary or mandatory? No, 271 AAC is mandatory. Once it is 215 BBE, 271 AAC is automatic, and 273B is not, as originally I said, 273B is not applicable to 271 AAC. It is not applicable to 271 AAB. 271 AAE, 271 AAD, it's not applicable. So therefore, it is A, it is mandatory. B, 273(1)B does not come to the rescue of 271 AAC. Next is if addition is made for not maintenance of vouchers, but explain that such expenses are part and parcel of the classified underreporting and misreporting. See, non-maintenance of vouchers, but explained as such as a part and parcel of classified and reporting. Can we classify the misreporting and file immunity? A, can we contest classification as misreporting and file immunity? No. Only underreporting can be benefit for 270 AA. Misreporting is not, is categorically denied that any benefit for misreporting will be available for 270 AA. B, addition of non-maintenance of vouchers, be explained such expenses. See, that you can go, you can say it's a business practice and part and parcel of the class. You can say it can be under reporting or certain expenses are disallowed, but you will have to substantiate that claim. For example, suppose conveyance, you're not maintaining vouchers for conveyance, but your business is such that a person has to go for conveyance or a rickshaw, he's a salesman, or say certain sales vouchers. Suppose there is a salesman and salesman goes there, you don't have voucher, but he says, he gives you on a writing that he's spent so much on conveyance. So he may not have a conveyance voucher with him, but there you can take that benefit saying that it's part of the business and the vouchers are practically not possible. So there, of course, you can, it in fact, it can be neither in reporting nor misreporting, or at the best under reporting. It cannot be beyond that. Very interesting. I had taken that subsequently. Can penalty under 271 AAE, which is again I have not covered in my section, but I'll explain why 271 AAE, because it is a very important section which has been introduced from assessment year 22-23 onwards, which is the current year, which is prevailing means as of now, and it is in the 271 AA for the benefit of the viewers is basically a section which has started levying penalty on on institutions and trusts covered under 1023C and covered under 12 the AB, and which refers to penalties on base again to the amount of paid in contravention to provisions of section 13(1)(c). And the question is here is that can a penalty of 271 AA be levied to a person referred to once as held to be unreasonable, excessive by department on a narrow interpretation of reasonable salary, and SSC has contested the addition? Can this is saying that I think penalty 271 AA, although it's notwithstanding, it is salary to a reasonable person, I think is a very good argument to be taken and can be taken for the benefit of the assessee. And in the Supreme Court, Raman and several other cases in British India and several big cases, they said that the department cannot sit in the shoes of the assessee to decide what is the right salary and what is the wrong salary. So if it is a reasonable salary which has been paid, it may be incorrect in the hands of the department, but correct in the assessee department. Yes, in cases where actually the person has not worked, the trustee, the person referred in 113(1)(c) has actually not worked, and he has taken salary, then of course, or there's a case, of course, a recent case where a person who has been given a perquisite to the extent of a Mercedes car and he's running a charitable trust. There again, it has been held that it is falls under 13(1)(c). In such cases, 271 AA would be levied. But where we can prove that salary has been reasonable, then penalty can be avoided. So I think I've covered the questions.
Those were the questions, sir. And is there anything you want to deliberate, or else can we conclude this?
I think that is basically 271 AA been covered. So I think that is probably an answer.
Thank you so much for excellent sessions and taking up all the questions. And if there's any questions, we'll share it to you or mail when time permits. You can respond it, sir. And are we permitted to share the presentation to the registered participants?
Absolutely. I've already given the copy there, of course, PDF already there. So case laws are there.
And certain case mail, sir. We'll share the recordings along with the materials in our website.
Yes. And there are certain case studies also which are in addition to this. So those case studies can be gone, and because the case studies have their answers also, so the viewers can benefit from the answers from the case study itself.
Thank you so much, sir. On behalf of SIRC, Chairman, Secretary, and Office Bearers in the absence, thank you so much for your time spent here, sir. And thank you so much.
Thank you so much. Thank you so much. Okay.